Hey everyone, this is Nick with Us versus Herd. Today we're going to be going over an introduction to options. What are options? What can you do with them? Why would you want to trade them? Here at Us versus Herd, we primarily trade options. It's rare that we purchase stock. Sometimes we trade futures, but mostly what we do here is trading options contracts. So before we dive into what an option is, I think we first have to understand what is a stock, and that's an underlying. So a stock is an underlying to an option. So a stock is a type of security that signifies ownership in a corporation and represents a claim on part of the corporation's assets and earnings. So when you purchase stock, you're actually purchasing a portion of that company, whether you're purchasing a very small fraction of that company or you're purchasing a larger percentage of that company. As you can see, I have Apple in the background here. And if you're purchasing stock of Apple, you are purchasing a portion of that company. So you're going to be sharing in its success or you'll be sharing in its failure. So if a company's not doing very well, the stock will go down, you'll lose money. If a company is doing well, they'll reward you with the stock price increasing. So as you can see here, the stock price of Apple is 143, and if you want to purchase that, you would be paying a purchase price of 143. So options are traded on top of the stock price. So an options contract is an agreement between two parties to facilitate a potential transaction on the underlying security at a preset price. So an options contract, for instance, if we wanted to trade an options contract on Apple, the underlying would be Apple. So let's go over to the trade page here. This is Thinkorswim. Most other brokerage firms have a options chain such as E-Trade. I'm also getting these definitions from Investopedia. So if you're wondering what something means in the trading world, head over to investopedia.com and you can type in what what word you're looking for, and it will give you the basic definition. Now it doesn't tell you a whole lot about it. That's kind of why we're doing this video, but it will give you the definitions. So going back to what is an options contract. There's two types of contracts. They're called puts and they're called and calls, which can be purchased to speculate on the direction of stocks or stock indices. So you can purchase options on stocks, or you can actually trade them on an index such as the S&P or the NASDAQ. But we'll just stick with Apple as an example. So on Thinkorswim, this is an options chain. Now, Apple's a more popular stock, as you can imagine. These have weekly options and monthly options. Some stocks that are less liquid, such as Domino's, they only have a monthly option. So if we were actually go to Domino's right now, you'll see there's a lot less dates for you to choose from. And in parentheses here, that means it's 14 days till expiration. So unlike stocks, options have a time limit. They expire mostly for the monthly. They expire every third Friday of the month. But if we're trading Apple, they have weekly options. So going back to Apple here, you can see starting today is April 7th, 2017. There's 0 days, so these expire today. For a better example, we'll go to the monthly options chain here, which is April 21st in this case. And as you can see, there's two types of options. On the left side, we have here our calls. And on the right side here, we have our puts. And as you can see, it looks very busy. We have the calls, we have the puts, we have a bunch of numbers in here, we have the date on which it expires, and then in the middle here, we have the strike price. Now maybe instead of displaying 35, we'll bring it down to 10, so there's a little less information. We'll go to 25 actually, so we get a better view. One options contract is equal to 100 shares of stock. So we'll go into detail a little bit later in the video of why that is and what that is. But just know that if you purchase either a call or a put, you are controlling 100 shares of stock. So instead of purchasing the stock outright, which I can show you here, we're controlling 100 shares of stock instead of one. So for instance, if I go to buy 1 share of Apple here, and now it's going to say buy the market price. I don't normally suggest buying. Actually, I never suggest buying market price. You always want to put it in a limit order. But for this case, for the example, we'll just do 1 share of the Apple stock. So if I buy 1 share of the Apple stock here, it's actually not putting in. Let's go to 1 share. For some reason, I guess it's defaulting to 100 here because I never buy stock, so I never change the defaults. But if I go to, it's not wanting me to change it to 100, but I mean to 1. We can go to 1 share of stock. Put a limit order in for 1 share of stock. Okay, there we go. So as you can see, I put an order in for 1 share of stock with commissions will cost me $150. So it's 143.67. As you can see up here, is trading for 143.67. So in this case, I'm trading 1 share of stock. So if I want to purchase a stock and own a portion of the company, I would just buy the stock. But with that, you get a lot less leverage. So with the option, you can control 100 shares of stock. You get full control of 100 shares of stock, and you get the reward of that. But it will cost you a lot less. So let's go, for instance, here. If I want to purchase 100 shares of this stock, it's going to cost me, let's go to 100 here, somewhere around $14,000. So if I wanted to, now it doesn't want to go to 100. Let's change this now. So let's say I want to buy 100 shares of stock. It's going to cost me $14,000. So one options contract equals 100 shares, and if I want to purchase 100 shares outright, it's going to cost me $14,000. Now let's go to the options page and see how much it would cost me to purchase an option, which would allow me to control 100 shares of stock. So we'll get into this later, but the yellow means it's in the money. The white means that it's out of the money. But let's say I wanted to control 100 shares of stock with an option. So let's purchase one option here. It's currently going for $1.91. And I have one contract here. I'm purchasing the 143 strike price for $1.91. And as you can see here, instead of $14,000, this is going to cost me with commissions $192. So it's going to cost $191 for the option itself, and it's going to cost me $192.50 with commissions. Now for options, you say, how is it going from $1.91 to $191? But because you're purchasing an option that's worth 100 shares of stock, you need to times it by 100. So this gets this price. So if you go, it's $1.90. Well, now it's $1.92. $1.92 times 100 is $192, as you can see right here. So that's where that pulls that number from. $1.91, $1.92 cost me $192 in buying power. So instead of me purchasing $14,000 worth of stock, I can control 100 shares of stock with an option. So let's get into the details of what is a call and what is a put. Now a call is an option. A call option is an agreement that gives an investor the right, but not the obligation to buy a stock at a specified price within a specific time period. So when I'm buying a call, it's giving me the option, but not the obligation. So I don't have to exercise it. We'll talk about exercise in a little bit, but this gives me the option to own 100 shares of stock if I want to. Now, here we don't usually ever exercise options. We pretty much just trade the premium of the option. But let's go back to the puts here. A put option is an option contract giving the owner the right but not the obligation to sell a specified amount of an underlying security at a specified price within a specified time. This is the opposite of a call option, which gives the holder the right to buy shares. So for puts, instead of buying shares, we're selling shares, so that means we would be short. For a call, we're buying shares, which means we would be long on the position. So what is a strike price? A strike price is the price at which a specified derivative contract can be exercised. So let's go into the options chain here, and let's just concentrate on the strike price. So the strike price is any of these in the middle. As you can see here, it says strike. And in the money means that the stock, let's just look at calls for right now. The stock is above this price. So currently the stock is trading here at 143.60. And let's try to get out of here so you can see a little bit better. So 143 is highlighted yellow. This means it's in the money. So if the stock is moving up, these will start being highlighting in yellow. So if you believe that the stock is going to move, for instance, to 145 within the period at which this option will expire, so in the next 14 days, if you believe that the stock is going to move above 145, you would then purchase the 145 option or the strike. If you believe that in 14 days, let's say they have earnings and you think the stock's going to move bigger than that, then you can purchase as far out of the money as you want. But as you can see, as the options get further and further out from where the stock price is, they get a lot cheaper because the probability, there's this column here, the probability of them becoming in the money is getting slimmer and slimmer as the further out you go. As when you're closer to the price, the probability of it going into the money is fairly good. As you can see, for the 144 strike price here, the probability of going in the money is 45%, but the probability at the 150 strike price is only 5%. So that is why the cost of the option, which is called premium, is way more expensive when you're closer to in the money than when you're further out. So that goes back to what is options premium. Options premium refers to the current price of any specific option. So like stocks, these buy and sell just exactly like stocks, but they're premium. You're not buying actual stock here. So you're buying and selling premium on the option. So options have their own price. So as they get nearer or in the money, they're more valuable because it's further away or it's closer to being in the money. So as you can see here, these ones that are 132 that are in the money, I mean, that's $11 away from the money, and that's why these are worth $11, $12. So this would be, if you wanted to purchase this would be $1,200. Now, why would you want to purchase this in terms of if you wanted to exercise it? So if you're not trading premium, you're given the right to exercise these options. So what does exercise mean? Exercise means that, let's say if I bought these 137 calls here, if I bought these for a premium of $710, I would then have the right to exercise I would then have the right to exercise the option. So I would be given the right to exercise 100 shares of stock. So I would then purchase 100 shares of stock at the 137 strike price. So I'm given the option to buy stock at the 137 strike price. So that is why you pay a premium. Obviously for this one, you're going to pay a lot more premium than you would for these out here, because this is deep in the money. You could purchase the 130. If you have this option here, you could purchase 137 no matter if this goes. If Apple goes in the next 14 days to 150, 160, and you exercise the option, it doesn't matter. You would then own the stock at 137. Now, on top of the premium that you paid for this to exercise the option, you would then need to pay 100 times 137. So on top of 710, you're gonna have to pay, let's see here, 137 times 100. You're gonna have to pay an additional $13,700. So that's typically why we don't exercise options, because unless you're in it for the long haul, like 5-10 years, we don't typically exercise the option. We typically just trade the premium. So if you're looking here, if you buy the 143's strike price on the calls and it moves up to 144, you're going to be getting, near $2 on that. So you would be getting like a $70 profit. So instead of these being worth 135, they're going to be worth closer to $2. And you purchase one here at 136, and Apple in the next couple days here moves up to 144 or above 144. These are going to be worth $2 or more. So you're going to be making about $70 to $100 on that option. Now that goes the same for if it moves away from the strike price. So let's say Apple goes down and you're buying calls. Let's say you bought the 144s and it goes down to 140. Now your option is going to be only worth 22 cents or like $22 or like 20 cents, maybe 30 cents at the most. So that's why you definitely want to have a good idea on what direction you want to take, because as fast as the premiums increase, they also decrease. And that kind of goes into theta. We'll discuss what theta is here. So theta is a measure of the rate of decline in which the value of an option due to the passage of time. It can also be referred to as time decay on the value of an option. If everything is held constant, the option loses value as time moves closer to the maturity of the option. So let's give some examples of theta. So theta is one of the major factors on an option increasing or decreasing in price. So if Apple moves closer to the 144 strike price and you still have 14 days, you're gonna hold a good value. But let's go to the options today. Now at 143, it's at 143.65 right now, and as you can see, a lot of these are only trading for 1 cent or 0 cents. And as you can see, I mean, we're going to come up on market close here in the next 30 minutes. And as you can see, like, these are basically worthless. And that's because, I mean, it's not likely, almost impossible, unless something happens in the news, that if Apple hits 160 in the next half hour, that's why it's only trading for 1 cent here, or $1, as is the 144 strike price. Even if you bought the 144 strike price, is only $2 right now if you were to purchase that, because it's less and less likely for it to hit. So due to time decay, or theta, and the probability of the stock moving towards our strike price, that's why the value of them are almost worthless now. As in, when you have more time, so this one's 14 days out, now the 144 strike on the calls is worth 135, because we have a lot more time for it to hit. We only have to move 40 cents. But for it to move up 40 cents in the next half an hour, we can take a look at the chart here, see if that's even, on the list, but probably not. Take a look at the 15-minute chart here. So, I mean, it could hit 144. As you can see, it did hit 144 a couple times a day, but for it to hit 144 in the next 30 minutes, the market is pricing in that it is not likely. And that goes the same for the put side. So the put side, if you instead of exercising stock or purchasing stock, this is the short side. So the put side, you're anticipating that the movement of the stock will go down, and we can see here. So if we want the stock to go down at 143, we think that in a couple days it's not going to be 143. This one's priced in at 118 here, but for today, on today's expiration, these are the same, 2 cents. So $2 per option for it to fall below or in the money at 143. So an option only really becomes valuable when it's in the money. Now, when the difference between the call and the put, so when we exercise a call, we actually are purchasing the stock, but when we exercise a put, we're actually short the stock. So if let's say these 144s, we purchase these options at 144s, they're in the money, we exercise it, and we're gonna have to pay 144 times 100, so that's $14,400. We're now short the stock. We want it to stay below, otherwise if it goes up, we're going to be losing money. So then we would then be short the stock instead of purchasing the stock. So that is pretty much the basics of options. We don't typically just buy and sell premium here. We have a lot more strategies that we put in place in a lot of different options to make money. So the one thing that we like about trading options is, unlike stock where you just buy and sell, there's a lot of options that you could put in place. Like for this one, you could put in let's give you an example here. You could purchase a single option, you could purchase a vertical, you could purchase a strangle, but those are a bit more advanced techniques. I just wanted to go over the basics of options, premium, what is an options contract, what does it do, and what does it mean when you become in the money. The one thing that I think I forgot to mention is that you can only exercise an option if it becomes in the money. There's really no point to exercise an option at 147 if you could purchase it outright for 143 right now. And that goes the same for puts. There's no point for me to short the stock at 140 if I could short up higher at 143 right now. And the other caveat to trading options, now if you purchase an options contract, and let's go to today's expiration. So let's say a couple days ago I purchased a Apple contract at the 142 strike price, and today it's worth 165, and I'm like, oh, I'll just hold on to it towards expiration. I won't take my money. I won't take my premium. I'll just let it expire. The money, if you do let it expire in the money, you do lose the credit. So you wouldn't be able to sell this for $160. You would lose all of that. And then the other thing is, your broker, most brokers are set to auto exercise. So if at the end of the day at 3 o'clock this stock is at 142, I'm sorry, above 142. Right now it's at 143. So let's say the market closed right now. I own this one option. The broker, whether you're a TD Ameritrade or E-Trade or whoever else, they'll auto exercise this option for you. And if you don't have enough money in your account, so if you don't have $14,000 to cover that, you're going to be in trouble. You're going to get a margin call, or they're going to do something else. It depends on the broker that you're with. So you might want to call them and saying, hey, please don't exercise my options if I forget to close one or something. But just be aware of the risk. So if this expires in the money, the broker is going to automatically exercise it for you and put an order in for you to purchase 100 shares of that stock or short 100 shares of the stock. So if you don't have the money for that, the different brokers go by different rules. So I would definitely call your broker and see what their rules are for if an option expires in the money or doesn't expire in the money. Mostly when an option expires out of the money. So if I had these today, if I had the 146 options and they expire out of the money, these will just expire worthless and no action will be taken. I'll lose all the money that I paid on this because I can't sell it now. It's worth zero, and it'll expire worthless, and it'll just be removed from your account usually by Saturday or Sunday. So just be aware of that. That's why we usually close all positions before expiration, and we don't usually trade like this close to 30 minutes into close is a bit dicey. Any news that can come out could cause some issues. So always take your profits, but just wanted to give you the risk of trading options near the expiration like that. If you have any questions, comment below, like the video, share it with your friends. We'd like to hear more about what kind of videos that you're looking for. So leave some comments below, subscribe to the page, and we're going to be pushing out some more videos on different option strategies.